This video is all about the real estate market crash that I don't think is happening. What's going on, everybody? Thanks for tuning into our channel. I'm Michael Chenkus with Charles Rutenberg Realty down in Lakewood Ranch, Florida, and today we're going to talk about the state of the real estate market. Specifically, all the doom, all the gloom, and all the bad press that you see out there right now. What does it mean? Do I believe it? Do I disagree with it? Where do I see things headed? And I'm going to give you specific examples of professional real estate analysts who probably have a lot better things to say than I about where the real estate market is headed. So I'm going to look at some expert interviews, analyze them, provide my commentary, and tell you how I think it plays into the market, specifically here in Florida and on a grand scale as well. All right, so first things first, you type in real estate market crash into Google, or in this case, YouTube. It's going to auto-populate some sort of result because that's what everyone's looking up. And then as you scroll up and down, it's all these wild headlines. It's a recession. The rates are the biggest problem. The 2022 crash is now denied. Let it crash. I mean, the big one. Crazy. Okay, it's all sensationalized because that's the kind of news that people like to read. Is just bad. So they pump the bad news. But if you rewind this little scroll here, I want to show you a specific interview right here from Joe Zeidel. Joe Zeidel is the chief financial something. I forget his title. It'll come up in a second, with Blackstone. And Blackstone is the largest global asset management company of real estate holdings, amongst other things. Their main asset is real estate. They own apartments, single family rentals, campus housing. They're really well known for a company that they founded about 10 years ago called Invitation Homes that did solely single family rentals. At the peak, Invitation Homes was buying $100 million of real estate a week. So these guys know what they're talking about, right? And then they sold that company in 2020 and started a new company called Tricon. So it's the same type of thing, single family rentals, apartment buildings, that type of thing. The direction of the market is clearly very important to them, so I wanted to hear what he had to say. I'm going to play a little snippet of the interview so that you can see this is a CNBC interview. There's articles online through Fox Business and whatnot that align with this particular video, and this is what he had to say.
That's a record. But one big player in the real estate market expects housing to hold up. Joe Zeidel is Blackstone's chief investment strategist. Joe, always great to see you. Where are we in the housing market?
So I do think that, over time, housing ends up, I think, having terrific supply and demand fundamentals.
Okay.
So that when we do get to a point where something breaks, I don't think it's housing that does.
Right. So he's talking about supply and demand fundamentals. And honestly, that's the number one most important thing in real estate, period. It's how many houses are available and how much of a demand is there for those homes, or how much of a demand is there and is the supply in alignment with that demand. So in the last 2 years during the pandemic push, we'll call it, the supply and demand chain kind of went crazy. So in 2020, everybody thought that's it, game over. COVID hit March, real estate's not going to sell. But the market proved everybody wrong and it went gangbusters. So the rest of 2020 was, sort of normal, decent volume. There was inventory that the builders had built, single family resale inventory to support the existing demand for the buyers. And then in 2021, something crazy happened. Like a light switch, we were selling houses, taking buyers around town, showing them to various neighborhoods and giving them options, right? Pick this house, do you like that? In March, give or take, like right around March 2021, all of a sudden that just changed. There were 10 offers on every single house. People were paying cash for their homes. Then it became people buying stuff sight unseen, never saw the house, coming from other countries. Everybody was in COVID lockdown. Their political situation where they're from may or may not have been favorable to them. And they started moving to Florida and other areas that were, in their opinion, more desirable in droves. And they would pay $50 grand, $100 grand, $200,000 over asking price, waiving all these contingencies just to buy a house in leave whatever situation they were coming from. High crime, high taxes, bad politics, bad government, terrible weather, whatever it might be. So those are some of the driving factors, especially with the clients that we've dealt with over the last 2 years. They're coming from somewhere and they have not just one, but multiple very strong driving forces. There's reasons that they moved. I digress. The supply and demand fundamentals. The point is, right now, the supply is very low. The demand is high to very high. When you have a low supply and a very high demand, that is not a recipe for a real estate market crash. So the news is pushing this story every day, everywhere you turn. CNBC, CNN, Fox, I don't care where you look. Housing market crash, housing market crash. Is there any validity to that? Let's look into that deeper.
This is not another setup to a 2007 or 2008 or 2009 type environment. I think there are risks out there in the economy, but in my opinion, housing is not one of those big risks.
What happened in 2007 to 2009? I first got licensed as a realtor in 2005. And my first year and a half to 2 years was awesome, right? Like I hit the ground running. People were buying houses in droves. The market ran itself up. But the cause of that was primarily substandard lending practices. Anybody, and I mean anybody, could, with a pulse, even some people with no pulse, were getting mortgages. No incomes, fourth or fifth house that they're buying. I personally witnessed mortgage underwriters falsifying documents, saying that someone made $150,000 when they made $60,000. It was very speculative back then. So investors were buying houses without ever intending to rent them out or live in them. They just wanted to buy it and sell it for more money. It was like nothing, the bottom could never come out. Everything was going up in price. So you had all this substandard, subprime lending. The whole mortgage market was basically corrupt. And that drove that entire market to crash. So I remember driving down I-4, and maybe it was like 2009, and we didn't live in Florida at the time. So we're driving down I-4 around Disney World, and I see all of these buildings that are like stick built and stuff. The roofs are flapping in the wind, and there's nothing there. I mean, there's no, you could tell like it's abandoned. And I asked somebody, what the heck's going on here? The builders had built up such a huge supply, all speculative building, figuring anybody can get a mortgage. The good times are rolling, let's keep going. So they speculatively built all this stuff, apartment buildings, condos, single family houses. And when the bottom dropped, they just stopped building. They pulled all their crews and they walked away. They handed the paper back to the lenders and the banks that they were borrowing from and basically said, we're out. Now, the people who bought the houses back then as well did the same exact thing because they had very little skin in the game. They didn't put huge down payments, if any. They falsified all their paperwork. So when the market crashed and they had no equity, none, nor did they have even an intention to utilize the property, most people. Not everybody, but most. It made more financial sense to literally throw the keys in the garbage and leave. The bank would take 6 months to a year to finally foreclose on the property, and then they had to fire sale all of this stick-built inventory that had never been lived in. It just created a mess, and the inventory went through the roof. Foreclosure inventory, which drives prices way down. There's more supply than the demand.
What I would expect to see is that housing activity is going to slow down because of higher mortgage rates.
Now, higher mortgage rates have happened. In the last 3 months, the rates have gone from roughly 3% to like 5.25%. On a month-to-month basis, that's like $500-600 or more dollars a month in your payment. That's a big deal. So there's this feeling of kind of people missed the boat, right? We don't think rates are going to go back down. They were so artificially low for so long, and we could thank the Federal Reserve for that. I guess they felt like that was the right thing to do. We'll see. I don't think it was a good thing. I kept on saying this money's too cheap. The monthly payments are artificially far too low for the cost, and it ended up, that had an impact to drive up prices as well because the money was cheap. Money is now at a rate roughly like 2009-ish. People have a short attention span and they remember, relatively short term. So the undervalued, the very low interest rates, they weren't going to stick around forever, but people just forgot that, right? Now we're at 5.5, and it's going to take some time, 3 months, 4 months, 5 months, for people to readjust, understand what it is they now can afford, swallow that pill, and move on, right? Either buy a house that you can afford, maybe it's a little bit smaller or it's in a different neighborhood than what you were hoping, but the ship has sailed and it's time to walk, but you'll still get there, I think is my point. So we're in an adjustment phase right now. What can you actually afford based on the new reality, which are interest rates that are far more normal than the abnormal rates we had from the last 2 years?
But when you think about home prices, and if you think about the things that cause home prices to drop, that really ends up being a story of labor markets. As long as the jobs market remains relatively healthy, I think housing will as well.
Okay, so now he continues. He's going to talk about labor markets and jobs and how he feels that impacts the real estate market. So this is a key factor. It's very important, very relevant right now.
So I think we could see housing activity slow, and certainly we could see home price appreciation. I think that's going to have to level off. But if you think about the factors that are going to cause a drop in home prices, you really have to have, in my opinion, the unemployment rate rising. And I just don't see that anywhere in the next 3 to 6 or 6 to 12 months. I think we're still in a relatively healthy jobs environment.
Right. So what he says is the labor market needs to be healthy. And the measure of whether a labor market is healthy or not is the unemployment rate. That's how we figure that out. So I looked at this next slide. It's from the Bureau of Labor Statistics, the U.S. Department of Labor. It's a government resource. And here's the unemployment situation or employment situation, whichever way you want to look at it, April 2022. So the unemployment rate unchanged, 3.6%. There's been an increase in employment of 428,000 jobs in April, yada, yada, yada. However, if you look at the chart, prior to the big peak that's leading up to COVID, you saw this like nice flat line, April, October, and then it gets into 2020, April 2020, bam, you see this massive spike in unemployment. That's COVID hit right then and there, in case you're living under a rock. That's what happened. So you see it slowly getting better, right? As the line goes down, that's better. And over time, as the unemployment rate dropped, that downward trend lifted the prices of real estate for, like I said before, socio-political taxes, whether just people ready to live it up in the face of imminent sickness, etc. So they had reasons. And then if you notice now, it's April 2022, and that line is back down to where it was prior to COVID. So unemployment has literally gone 360 through the pandemic and gone back to normal.
So, Joe, if the Fed is going to keep raising until something breaks, does that mean that the housing market could break?
Oh my God, I had to pause it there. She's using the word break. I think she's using it as a B-R-E-A-K, like break an arm, break a leg, damage, right? Break. But in reality, what it's doing is breaking. It's saying, whoa, hold on a second. The unnatural price run up, the overinflated offers that were coming in, over asking 10, 20%, all cash, waiving inspections, no appraisal. All that wild stuff that happened over the last 16 months or so, that's what's stopping. I came up with an acronym to explain what was going on. It was 4 Ps. Pick your price, people pay it. People come up, what do you think my house is worth? Well, in all honesty, let's pick a price because people are paying it. A home would hit the market, the price looked absurd compared to what similar properties had sold for over the last 12 months, sold. So that pick your price, people pay it, that's gone. It wasn't natural. I used to joke, like, you could take a picture of a toilet, post it online, for sale, 4 bedrooms, 3 offers the next day, under deposit, closed, cash, done. There's one last segment that I thought he made a great point. Joe Zeidel talks about how people aren't using their homes like an ATM machine.
Sure. Well, if we're to think about the sort of the silver linings here, it's that you don't have a lot of excess in housing. In other words, you haven't had overbuilding, you haven't had a drop in credit or lending standards, and you don't have people using their homes as an ATM the way that they were, in the great financial crisis.
What he's referring to is back in 2007, there was a massive amount of home equity lines of credit, cash out refinances where people would refinance their house for more than they had paid and take a big lump of cash and go spend it on a vacation or a brand new kitchen that they didn't need. And they ended up over leveraging themselves. They had no equity left.
And it was really that last part where people were tapping their equity in their homes that caused so many people to go upside down, where the value of their, what they owed was greater than the value of their home. They walked away, they turned the keys to their homes over and they walked away. That negative equity, we're nowhere near that. If you look at HELOCs, the cumulative use of HELOCs today, home equity lines of credit, is still 60% below where it was in 2007.
The chart that's on the screen right now shows that, but it's deceiving because this chart it's in dollars. The up and down, that's dollars. It looks as if, oh my goodness, we're going right back to where we were when all the problems occurred in 2006, 2007. But in reality, if you look a little deeper, this Fox Business article actually highlights this Black Knight data chart, and you'll see the very last sentence, and you can read this. I'll leave it on the screen long enough. But they're only withdrawing at half the rate of what they were in 2006. Half the rate, meaning half the amount of people are doing this. It's actually about 60% less. There's 60% less people cashing out of their house on a cash out refi, pulling out equity through home equity lines of credit and going on cruise ships. If you ran this market for the last few years, you own a house, you bought it in, say, anytime within the last 10 years, you have equity in your house. It's almost guaranteed. I think we all know the house values have gone up, right? And they've gone up considerably through supply and demand principles. Now, you have a lot of equity. Are you going to just throw the keys in the garbage, walk away, and let the bank foreclose on your property so that you get no money, nothing? You just hand the house back to the bank. Nope, most people they're not going to do that. They could easily put their house on the market if they needed to sell for whatever reason, sell it and get the cash. There's not a lot of like dine and dash going on. Back in 06, 07, they literally just shut the door, didn't even lock the front door and left. It made more sense to default on the mortgage and let the bank deal with it. Kill their credit, bankruptcies. There's a lot of bad stuff happened in 06, 07. None of that's happening right now. And that's Joe Zeidel's point on this.
And at the same time, home equity is at an all-time high. So if we think about those things that are going to break, because in my opinion, because you have very little excess in housing, I think you end up having less risk. So you might see home prices generally flatten out. You might have pockets of weakness where home prices in some regions might fall. But the idea of having a national and a prolonged drop in housing as the economy eventually rolls over, I think is still a relatively low probability.
Okay, so my final point in closing, do I think the housing market is going to completely crash and look like 2006 and 2007? No. Do I think prices will come down? Yes, on the properties that deserve price reductions. Do I think prices will come down on all properties? No, absolutely not. Because if you price something appropriately, people will pay it. The 4 Ps. Now, the balanced supply where it's not buyer, not seller market, it's just kind of even, is 6 months of supply. Nationally, they're saying there's around 2 to 2.5 months of supply. So it's still a seller's market. It's probably going to stay that way. And then locally, I have some stats from our local board of realtors here in the Manatee, Sarasota area. And locally, they're saying there's about maybe 1.5 months of supply, give or take like 1 month. And clearly that's not enough for a balanced market either. So we're in a position where it's going to take more people selling their homes for things to kind of flatline. But it's still a good time to buy a house. Florida is really the place to be. We don't see that changing. The dynamics of our economy, you can work remotely, industry's booming. We have a lot of people moving from out of state for some of the reasons I just mentioned or others. It's not just a place to come when you retire anymore. If you want to just chat about this, give us a call. Want to send us a quick email, send us an email. Do us a huge favor and like, subscribe, and comment to this video below. We'll be happy to get back to you. We answer every single comment. Subscribe if you think this information is helpful, and we'll talk to you again soon. Again, I'm Michael Chenkus with Charles Rutenberg Realty down in Lakewood Ranch, Florida. Thanks for watching.